Okay guys, in today's video, I want to follow on from what we did in the last video when we started talking about exit strategy. So in the last video, I was explaining when you should move your stop loss to break even. And it wasn't just like in any case, this is what you should do to move your stop loss to break even. It was just a specific, very simple rule that you can follow, riding the waves, riding the structure that will help you to avoid those situations where you end up having a winning trade turn into a loss, or avoid those situations when you move your stop loss too early and end up at break even when you could have made a lot more money in the trade. So this again is going to tie into that because it's following the same kind of principles, but more than anything, I'm just establishing the sort of base foundation layer of what will make up your exit strategy. Because as always in trading, it's not just black and white. There are a lot of gray areas and there's a lot of context-based situations that you'll find where you'll do something slightly different in them. And you'll probably see with my trading as well that sometimes I break the rule of what I'm teaching you now, but because the context, that specific situation calls for a different course of action. So what we want to talk about today is your trade move potential. You may have heard me mention it before, particularly in our technical analysis videos, or you might have heard me call it TMP, which is what we call it for short. So your TMP, your trade move potential, this is what you base your profit target on when you're entering a trade. But I've just said the sort of dirty word that I shouldn't have said, which is target, because a lot of people say, well, isn't your TMP just your target? And that's why I try and avoid using that word, and that's why I came up with that funny little phrase, trade move potential. It's essentially, it is a target in a way. It's basically when you're entering your trade and you're assessing your risk reward, obviously the risk is based on where your stop loss is. So let's say your stop loss is 10 pips. Then your TMP is making up the potential return side, the reward side. So let's say that your potential TMP is 30 pips, your risk side, the stop loss is 10 pips, that's a 3-to-1, that risk reward. Well, other way around, 1-3 risk reward. As I mentioned in the last video, the way that I'm going to be explaining this is by using the Duomo method, because that's obviously how I trade and what we teach around here. But I hope that even if you're using a different strategy or a different approach to trading, you can still pick up on the logic behind what we're doing here, and you can maybe apply that to your own trading as well. It's just that the sort of core of what we're doing will be based on principles from the Duomo method, but it's the logic behind it that could be applied to anything. Right, let's go over to the diagram and I'll explain everything for you with my squiggly, funny little picture here. So I think the first important thing is for me to actually define and explain what a TMP is. So if I had to sum it up in a couple of sentences, I'd say that it's a conservative estimate of where your profit could be. So you're looking at if the price moves in the direction that you expect it to, what's like the worst case scenario while still being something realistic based on your analysis. So obviously we know there are going to be significant levels around, we know what the structure is like here. At what point would you say this will be the first obstacle, the price might fail at this obstacle? And the reason we do it this way is because every moment that passes, every candle that appears on the chart, the context is slightly changing. The sentiment could be slightly changing. So of course you can enter a trade and hope that it's going to have a target like 100 pips from where you are, but everything changes once you enter that trade. So once you've entered that trade, it might not reach your target. Once you get to that target, if you did have one and it reaches that point, it might actually go further. So what we want are sort of context-based exits, which is what I mentioned yesterday. You're exiting your trade based on the context at that moment in time and choosing the point in time when it looks like the price is going to go against you so much that you don't want to be in the trade anymore. But for assessing whether it's a viable trade in terms of risk reward, then you need to have a TMP. You need to have a trade move potential. And this is part of what we build into the Duomo method with everything we do, is being very conservative and defensive. So if you go for a conservative estimate of your profit target and say, is that a 2-to-1 trade, is that a 3-to-1 trade, and then look at that combined with your success probability for that setup and say whether it's a viable trade or not, if you base that on the conservative estimate, you're being very defensive, and that's a good thing. Because of course, let's say that you expect that it might go 100 pips because you think it's going to catch on to a bigger wave and it's going to move very far. And you say that your stop loss is 20 pips. You could say that's a 5-to-1 trade, but it might not reach your target. It might be best to have a conservative estimate instead. Now your conservative estimate might be 20 pips away or something at the next swing high, and that will make it a 1-to-1 trade, and you have to then assess whether your success probability for that setup makes it viable or not. Now you might be sitting there thinking, well, if I look at the first obstacle that's on the chart, that makes it a 1-to-1 trade or maybe even less, which is not really what we want to do. We always say you want to go for a 2-to-1 or maybe even a 3-to-1 trade as a minimum. But at the same time, you might have that as your risk reward by using the TMP and the stop loss, but your actual target or what you expect the price to do, if you expect it to move 100 pips, might make it a 5-to-1 trade. So in those situations, I say that you can override it. You don't have to stick to the TMP. Like the TMP is there and it's useful and everything, but at some point in time, you'll get to a situation where it's such a good opportunity. And so you might say, okay, fair enough, the risk reward if I use the TMP is too low to enter the trade, but the potential of this movement and what I expect to happen is so significant that I'm willing to ignore that and go for it anyway. That's completely up to you. But it's just a way to estimate with just the normal trades when we're looking at normal fluctuating markets to be very conservative and defensive about things. And also realistic, because like I said, once you enter the trade, the sentiment and the context can change like that. We saw it the other day, in fact, with cable this week. The market was looking like it was maybe going to reverse a little bit. We had the US government shutdown avoided. And then this week we had comments from Mnuchin and suddenly the market's shooting up again. So of course sentiment can change and you don't want to be stuck in a trade thinking that your original target is still going to be hit. You have to change the way you're looking at things. But anyway, enough rambling, let's get on to this. So let's say that we entered here. We're obviously going with the trend and it's the same diagram as before. We get a double confirmation where there's a horizontal significant level, let's say, I don't know, a Fibonacci level or 50% retracement, and you've got the trend line, a baseline trend line. So you're going to go long here. So there's your entry. Let's say for argument's sake that your stop loss is based on the structure of the market. So it's at the previous sort of higher low. So it's here, that's your stop loss. Now, in terms of your TMP, your trade move potential, remember we're looking at the next obstacle. Now, obviously if the market's pushing up, there's going to be an obstacle over here. This is technically over here is going to be another horizontal significant level because it's got to break above this wave where it's reversed the price before to create a higher high. So ignoring all other analysis on our charts and just focusing on the same structure that we were looking at yesterday, we would say that this is potentially our TMP, our trade move potential. Now, in reality, you might think that this market's going to go and move all the way up here, like the waves are going to continue like it did previously. I shouldn't have done that. But your first obstacle is creating a new high. And so you're basically, when you're entering a trade, you're suggesting that the market's going to be breaking to create a new high. It's going to be a good trade because of that. But in any case, this is what you're basing your risk reward on, that you're going to be conservative and say, well, worst case scenario, if I see it struggling here, I will exit, and that still makes it, let's say it's a 2-to-1 trade or something. Okay, we're just going to pause the video there for a second because when we were watching the video back, we realized that I wasn't being clear enough about a very important point about why we use a TMP. So when we're opening a trade, we're basically declaring that we expect the price to be moving in that specific direction. If we open a long trade, we're expecting a bullish move. If we open a short trade, we're expecting a bearish move. It's very straightforward. And usually when we decide that, because of course at any moment in time you could guess when the market's going or have a good idea of where the market's going, but you open a trade because you think it has potential to reach a certain amount of pips. You think there's enough potential in that movement to make it worthwhile opening a trade and putting your money where your mouth is. However, when you open your trade, from that point onwards, all of the analysis you've done up until that point is now old. And every candle that moves, things change. So imagine that you open a trade based on a daily chart. 5 days later, you might still be in the trade and it's moved a bit into profit, but you're not going to use the same analysis that you used 5 days previously. You're going to use your analysis at that point in time. Therefore, since we know we're going to base it on the context of that specific moment when we're in the trade, we need to know at the point of opening the trade where that first obstacle might be. Where is that first point where we might decide in that specific moment to exit the trade? And that's what we base our risk reward on because that is what's going to be most conservative and the most defensive approach. However, that doesn't mean you need to exit your trade at your TMP. It's not a target. You're still basing your exit of your trade on the context of the situation at that specific moment in time. When you have the structure on your side, it's straightforward. Like, you know that's going to be your first obstacle. Of course, if there's something like a baseline trend line between, like along here, you know that your TMP is going to be here instead. But what happens, for example, in a situation like this, where the market's been in an uptrend, it starts to break below, creating a lower low there, and then you enter short. Well, of course, your stop loss is likely to be somewhere up here that it's going to go and create a higher high, or it could even be a little bit lower based on some other analysis there. But what about your TMP? How are you going to assess whether this is a viable trade in terms of risk reward? Of course, your target may be like reversing the entire trend all the way like down where it came from days and days ago, but there's going to be obstacles along the way. And which are the first obstacles that could truly start to reverse the price and push it against you? Like, what is going to be your conservative target? Well, in these cases, you might have to start using the actual analysis that you have there. So, of course, you can have like trend lines if you have them on the chart. Especially, for example, if you're going in a downtrend and you have the line going along there, then you have somewhere where there's going to be an obstacle, because even though it's a downtrend and you're going short, you're going like expecting a bearish movement, it could bounce along the line, and it's that every time it bounces, it could create another wave up. You could go back into loss. Sometimes it's best to take the exit, take the profit, and find a re-entry instead. So these are all decisions that you have to make, but it's good to be conservative about it. So if you see there's a place where there could be a double confirmation, or there's a particularly strong, significant level of some sort, then that becomes your TMP instead. And if you haven't got anything over there, then this is when we start using things like our Fibonacci extensions. Because if, for example, and it's not going to be the case with this picture here, but let's say that you have an A, B, C up here, confirmed C point, then you know you've got some confirmed extension levels potentially below the price. And if the price is breaking out of that range, out of that wave, you know that it's going to potentially interact with those extension levels, and those could be the first obstacles for you. So you want to make sure your TMP is always conservative. So you want to look at it realistically and say, in the worst case scenario, as this trade starts to go in the direction I want it to, at what point could it potentially reverse and I get it wrong? What point could sentiment change? If I'm wrong about the sentiment and I'm wrong about the eventual target that I'll get to, what point could that change? And as you keep going on, you keep anticipating that and start thinking like, at these next points, what's the decision going to be? And that kind of leads on to what I want to talk about in our next video on exit strategy, when I actually speak about how you decide when you're going to exit a trade if it hasn't reached your target, or when it's reached your target, how you decide if you're not going to exit at that point. So this is all about the context. This is all about making those decisions based on what the candles are showing you. I don't really want to see anyone doing the same thing where they enter a trade and then their target is like 200 pips away because that's a level it's been at before, and they wait until it gets there. Sometimes it doesn't get there, sometimes it does, but it goes further and they've exited at that point even though it was looking like it was going to go even more in their favor. Like, as a trader, your job is to analyze the situation as the market's developing, as the price is moving. It's not like just because you enter a trade, everything else gets stopped in time and the price just moves to your target. Things are going on all the time, things are changing. And as the price is moving in a certain direction, people's sentiments changing or people's analysis changing, and the price can change course as well, change direction. So we need to be aware of this. I hope that you understand what I'm talking about with the TMP here. It was only a sort of brief explanation of it, but it's really important to understand the difference between a target and a TMP so that we can move on from that and start to understand some of the context-specific stuff. So as always, if you like the video, please do hit the thumbs up button and leave a comment below. Let me know what you thought of it, what your favorite bit was, any questions that you have. If you're a member of our forum, then there's going to be a post put on probably this evening, which will be for us to be able to discuss this in a bit more detail, so we can share some screenshots. I can give you some feedback on areas where you weren't sure about your TMP, or you weren't sure about whether you've done things correctly, like we can correct that. So make sure you go on the forum tonight and start to discuss that with us there. And otherwise, if you're not subscribed to the channel, make sure you subscribe so you don't miss any of the other stuff on exit strategy, as well as all the other videos we have coming out. I appreciate you watching. As always, take care, and I will see you soon.